All right, thank you so much for joining me in this video lecture. This is Gurpal Singh from Gurpal Education. As you all know that we have already started and we are ushering towards the new series regarding the video lectures for financial management. I have delivered you already the introductory lecture in which I have explained in a very detailed manner that what is going to be our next stages for learning regarding the financial management. So we have already gone through from that, and we have already gone through from the analysis of financial statements as well. So in this lecture, we shall be talking about one of the very important and major topic regarding financial management. So I shall tell you details regarding capital structure. So you shall be understanding then how and in what ways you can collect the money so that you can invest it into your business. So after that, what should be the proportion, and most importantly, what are the basic theories of a capital structure? And that is going to be the main part of this complete lecture. So when we talk about a capital structure, basically what we have to do, I'm just going to give a very brief description of the details what we are going to cover in this video lecture. So first of all, we shall talk about leverage as well. Okay, so when we talk about leverage, that stands for the mixture of debt and equity. So as you know that you can raise the money from shareholders and debenture holders as well. When a company uses debentures along with equity capital, then the complete mixture of these two is said to be the leverage. Okay, so when a firm is using high debt in its capital structure, then that firm is said to be highly leveraged or in high gear. Okay, so when a company is using comparatively lesser portion of a debenture in their capital structure, then this company is known to be the company with the lower leverage or company in a low gear. Okay, and after that, there are some of the very important and very beautiful, we can say, theories which tells you what should be the exact proportion of debt and equity mixture so that you can maximize the value of your firm and you can simultaneously reduce the overall cost of capital for your firm. So for these two things, like maximization of value and minimization of your cost, there have been four important theories regarding which we are to cover in this lecture in a very detailed manner. So maybe that this being the large portion, this could not be covered in a single video lecture. Then whatever the video lectures are upcoming, we shall be joining these two, and one video lecture, maybe it can be more than 1.5 hour, that shall be added to the previous one. So I'm just going to share with you the screen. I hope you would enjoy that. See it now. All right, so now in the screen you are able to see it has been written that capitalization and capital structure and its theories is going to be our today's topic. Before starting this topic, I must tell you the agenda, what we have to follow. First of all, we have to cover regarding the capitalization. You have to understand regarding that, okay, there are different terminologies involved in capitalization. After that, you have to understand regarding the financial break-even point. This is very important thing, okay. After that, the equivalency or indifference point of equivalency or indifference point, about that you have to understand. After that, you have to understand regarding the optimal debt and equity proportion. This you have to understand, and after that, one by one, we have to cover all the theories of capital structure. And I must tell you, it's not possible to cover this topic in a specific time frame. It can take more, I think, 1 or 2 lectures, or it may be the possibility that if we start solving 1 or 2 practical example as well, that it can take 3 lectures as well. So this is going to be the first part of teaching you capitalization and capital structure theories. So the first thing we have to understand regarding capitalization is what are the different terminologies involved in that. There are 3 kind of the terminologies which you have to understand regarding the capitalization and capital structure. So the very first thing is, this is capitalization. Okay, what does it actually mean? This is a quantitative aspect of all the financial planning. Okay, regarding financial planning or what are there, we have covered so many basics regarding the financial management. You can easily understand that when you come up with the idea, you make a financial plan as well. You make a financial plan, like what should be the level of funds you should raise. Okay, at the time of raising of the funds, you just make a plan. Okay, regarding raising of funds, we have already taken the lecture, uh, sources of finance, in which I have taught you from where you can get the money in order to start your new venture or enterprise. So it's not that you require so much money. It's obviously you always have a plan in mind that this is the required amount of money which should be there with me so that I can start the business. So this is the quantitative aspect of financial planning of business, and that's known as capitalization. And the second, it obviously refers to the securities issued by the firm. When we talk about securities, these are usually of three kinds. Okay, the first are equity, the second is preference, and the final is debt or debenture capital. Okay, so whatever the amount you raise by issuing these security, these are also known as capitalization. So these are the two basic meanings of the word capitalization. In the context of this specific lecture, we shall not be considering preference share capital in detail, because these are studied along with the equity capital. So basic two kind of securities we shall be talking about in this video lecture. The first are shares, which includes both the shares like equity and preference share capital, or specifically the equity capital. And the second, we shall be talking about debentures or debt capital. Hope you have got the idea regarding capitalization. So capitalization is the sum total of amount you raise by issuing the securities of the firm. So that is the capitalization. Okay, when we talk about the capital structure, okay, so capitalization is a different from capital structure. So capital structure is a qualitative aspect. So capitalization was a quantitative aspect which tells only the total amount of funds raised by you. But the capital structure tells you the qualitative aspect, that how many types of securities have been issued, and to individual security, how much funds have been received from that. Like you have issued equity, you have issued a debenture, you have issued a preference share, and you have how much money you have raised from all these securities. So this is the qualitative aspect. So it refers to the type of securities and their proportion amount which makes up the total capitalization, which we have already understood. And the last one is the financial structure. Some authors include this into consideration as well. In the books, this has also been given. All the credit side, all the credit or liability side makes up the liability side of a balance sheet makes up the financial structure, because they don't consider the securities of just two or three types, but they assume that each and everything existing on the liability side is in one or other way the source of raising the fund. So this is why they take up all the items available on the liability side. So it can consist of a specified percentage of a short-term debt, long-term debt, and shareholder funds. So they categorize all the side of liability into three parts. The first are short-term debts like creditors, bills payable, etc. Then long-term debts, these are debentures, and finally the shareholders fund. This is equity capital. So I think you have got the idea regarding capitalization. This is the sum total which is received by issuing the securities. And then there is capital structure. This is the qualitative phenomena which tells you how many types of securities have been issued and what is the specific proportion of a specific type of security. And the last is a financial structure, which tells you completely the information or proportion regarding the complete liability side of balance sheet. And then what you have to understand, this is, so as I always teaches you in a way that you have to uh, understand a specific example, and on the basis of that example we can cover whole of the lecture. So again, in this way, first of all, I would like to show you this specific table. Just to keep this in mind, if you understand this table, believe me, understanding the upcoming topics shall become very easy for you. The first is EBIT. EBIT is just your operating profit. Okay, operating profit before interest and tax. So EBIT stands for earning before interest and tax. So this is your operating profit which is received from the profit and loss debit side. This is your net profit, but this has not been adjusted for interest and taxes. So we write here earning before interest and tax. So if we write it here, so its values should be written here. After that, if we deduct interest from earning before interest and tax, then we are left with a specific value which is known as earning before tax. Okay, just get the idea again. So this is earning before interest and tax. It has specific value. When we deduct interest from that, then you have to write its figure. When you deduct this from that, then you are left with earning before tax. And when you deduct taxes from EBT, EBT, so this value, if I deduct taxes from EBT, I shall be left with a specific value which is known as earning available for shareholders. So this is known as earning available for shareholders. Okay, and when earnings available for shareholders are divided by total number of shareholders, then you can get the value of earning per share. This is EPS, and this is the very important and very beautiful concept which you have to study before the study of a capital structure. Okay, so why I have taught you now this? Okay, so I have not answered this question right now because I just want you to just keep all these figures in your mind. Okay, first of all, you earn the net profit. This net profit is known as operating profit, and this operating profit is also known as earning before interest and tax. And first of all, the adjustment of interest is done and taxes are paid afterward. So when interest is reduced, you are left with the value of earning before taxes, and when tax is deducted, you are left with earnings available for shareholders. And when earnings available for shareholders are divided by number of shareholders, then you are left with the value of earning per share. And this is very important thing. And why this is important, I'm not going to tell its answer right now, because in the upcoming slide you would be realizing that learning this specific table was very beneficial for you. So what do we mean by financial break even point? I taught you that before, in the very start of this lecture, I told you that we shall be talking about all the terms related to capital structure. Terminologies we have already gone through, but this is the very important and beautiful concept regarding which once the question was asked. Once or twice, I think FBEP question was asked. So this is financial break even point. When nothing is left to equity shareholders, when nothing is left to equity shareholders, in that case you are obviously, in this case, you just consider this is the break even point. Okay, just remember the concept in which I taught you in economics. I taught you regarding total revenue and a total cost, where total revenue and total cost is equal. You are, so this is, if I am making this curve for the total revenue and this curve for the total cost. Okay, so at the point they both are equal to each other, this is the break even point. And break even point is the point in which you occur no, you receive no profit and no loss situation. Okay, so this is break even point. So at that point, neither you are suffering any kind of losses nor you are earning any kind of profits. Okay, in the same way, there is the financial break even point in the subject or in the theory of a financial management. It tells you that neither you are suffering any kind of losses nor you are earning anything for your shareholders. This is the situation of a financial break even point. Okay, you are covering only your only your expenditures. Okay, where EPS is zero, where EPS is equal to zero, this is your financial break even point. Now you would realize the importance of this specific table. When you have suppose we are taking hypothetical example, 50,000 EBIT, the interest is also that. Okay, the interest is also that. This is 50,000, you are left with nothing, you have to pay no taxes, then earning available for shareholder is nothing, this is nothing, and earning per share is ultimately zero. So in that situation, if you are just earning the level of income which covers only your expenditures, and there is a zero earning per share, this is the situation of financial break even point. So financial break even point attempts to find EBIT that results in zero net income. So this is the point of earning before interest and tax, the result of which produces the zero net income. So it can be expressed as like this. Okay, so this is earning before interest and tax is equal to fixed charges. If this is the case, if earning before interest and tax is equal to fixed charges only, which are interest and preference dividend, okay, so in that case it shall be left with a zero balance of earning. Okay, and nothing is left for equity shareholder. This is in the vocabulary of a financial management, this is known as a financial break even point situation, in which shareholders are left with nothing. Now we have to study regarding optimum capital structure. Okay, this is the concept of optimum capital structure. So what's that? What you know that the funds could be raised by so many sources. Okay, and when we talk about the capital structure, we have to take into account two kind of securities: the ownership securities and the creditorship securities. In case of ownership securities, you have to study the equity share capital, and in case of creditorship securities, you have to study the debenture capital. To equity share capital, there is no fixed income. Okay, so they have to be paid the residual of income. Okay, so whatever the income is left after paying all the expenditures to outsider, that ultimately goes with the equity shareholders. So we can say that uh, their income varies. Okay, so this is the variable nature. The income of the nature of income of equity shareholder is variable. But in case of debt, their income is sure, like 8%, 9%, or 10%, whatever the norms of the company are there. So debt are given the specific percentage as their income for investment. Okay, so you have two sources. Being an entrepreneur, being a company, you have two sources to raise the funds. First are ownership securities or creditorship securities. In case of ownership securities, you can pay any amount, whatever is left after payment, to all the sources of finance, and but you have to pay the specific amount or fixed amount to your debenture capitalist. So this thing you have to keep in mind. Okay, so on the basis of what you can afford, on the basis of that, you should decide your optimal capital structure, and this is our next concept. Okay, so optimal capital structure indicates the best debt to equity ratio, like how much debt should be issued, how much equity should be issued, what should be the proportion between equity and debt, so that your overall cost gets minimized and the value of your value of your company maximizes. Okay, because your purpose is always to maximize the value of your company and minimize uh, the cost of capital. Okay, so the proper and the best kind of debt to equity ratio ensures the optimal capital structure which shall lead ultimately to this situation. So the optimal capital structure indicates the best debt to equity ratio for a firm that maximizes its value. Okay, so this is simply that. Putting it simple, the optimal capital structure for a company is the one which offers the balance between idyllic debt to equity ranges, thus minimizing the firm's cost of capital and maximizing the firm's value. This is all about that. So now we have to consider something relating to equivalency point or point of indifference. Okay, after that we shall be covering this topic, and we shall be able to go further with some other topics like theories regarding capital structure. So the most important topics to start with this specific chapter were two. Okay, the first was a financial break even point. If you have knowledge of this, understanding capital structure and its theories becomes easy for you. And the second is the situation of a point of indifference. Point of indifference. Okay, point of indifference. Just understand this concept. Okay, so you have so many alternatives. Okay, so if you wish to raise 1 lakh rupees, okay, so you have so many options. You can issue 100% equity, you can issue 80% equity and 20% debt, you can issue 70% equity, 30% debt, you can issue 50% equity, 50% debt. You have so many options. Okay, so many options. So many options for investments also are available to you. Okay, so the level of investment, the level of investment, okay, the irrespective of different ratios of debt and equity. Just try to understand what I'm telling you. Okay, the level of investment irrespective of the mixture of debt and equity, if all these produces, if this produces the same level of earning per share, okay, if this all produces same level of earning per share, this is known as a point of indifference in the vocabulary of financial management. Okay, so the earning per share equivalency point or point of indifference refers to that EBIT, that level of earning before interest and tax, interesting before interest and tax level, at which earning per share remains the same. It remains the same irrespective of different alternative debt equity mixture. So irrespective of whatever the mixture is there, the level of earning before interest and tax which yields you the equal amount of earning per share, that is known as a point of indifference. So point of indifference is very important to know. Okay, at this level of earning before interest and tax, you are completely indifferent for any kind of a debt and equity mixture. You can choose any, you can choose 50-50, you can choose 70-30, you can choose 40-60 or any mixture. Okay, so if so far as these mixture are generating the same level of earning per shares, then you are indifferent about these, because you can choose anything randomly, any of the mixture randomly. So at this level of EBIT, the rate of return on capital employed is equal to cost of debt, and this is known as break even level of EBIT for alternative financial plans. Whatever the financial plan is there, whatever the debt or equity mixture is there, the EBIT is at break even level. Okay, so you can simply show this in this way. Okay, so suppose this is the equivalency point, this is the equivalency point. You don't need to be bothered about that. Okay, because the questions are not going to be that much specific, but formula you must remember. So this is the situation. Okay, so This is I1. I1 stands for interest under the first financial plan. This is I2, interest under the second financial plan. This is 1 minus tax, 1 minus tax. This is preference dividend and preference dividend. Okay, so there are two alternatives with you. Alternative number 1 is on the left hand side, alternative 2 is on the right hand side. And S1 stands for the number of equity shares for alternative plan 1, and S2 stands for number of equity shares for alternative plan 2. Like mixture 1 or mixture 2, you can say that. Okay, and when you solve this equation, this value of X shall produce the value of EBIT, which shall give you the same level of earning per share. Okay, it shall give you the same level of earning per share. So the value of X by solving this equation shall be known as equivalency point or point of indifference or break even earning before interest and tax level. So at that situation, that shall be the level which shall produce the equal amount of earning per share. I hope you have got the idea. Okay, I'm just explaining it further, so I don't think there is much need for that. So financial break even point and the equivalency point were the important things. Okay, so I think that is going to be the last term for the basics of a capital structure. After that, we can move for further and the advanced level understanding of capital structure. That is going to be capital gearing. Okay, so what's that? So this is just the relationship between equity capital and long-term debt. So relation between equity and debt is known as capital gearing. Okay, leverage. Okay, so when you are using higher debenture, higher level of debenture, like from equity, like 50-50 or 50 40-60, if you use higher level of debt, then the company as is said to be in high gear. In high gear. And when you use proportionally large amount of equity and you don't use that level of debt, like you use 60-40, then the company is said to be in a low gear. Okay, low gear. So use of high proportion of debenture in your capital ultimately leads to the leverage. Okay, about which we have to take the separate lecture or separate topic or separate chapter is there. But I must tell you the name of the levered firms. Okay, some firms are said to be levered firm. Why these are said to be levered firm? Because they have a higher proportion of a debenture in their capital. Hope you have got the idea regarding the different terms of a high gear, low gear, and levered firms. Okay, so I hope these all are clear to you now. Once you have completely got the idea regarding what I have taught you till now, now coming towards the different kind of a capital structure theory becomes very easy for you. As I have already explained you that it won't be possible for covering whole of this chapter in just one lecture. We can be taking the next as well, but I see how much could be covered in this specific lecture, because I still believe that time is left. So just recall all the things what we have taught, what we have learned till now quickly. So in this lecture, I have taught you regarding capitalization, after that capital structure, then financial structure. You have understand these three were terminologies of the chapter headed capitalization and capital structure. Then I have taught you this specific and very important table. This will be used throughout this specific lecture. Then we learned about financial break even point. Then we talked about the optimal capital structure. I taught you optimal capital structure is the structure or the level of debt or equity ratio which produces the maximum value to the firm and which charges minimum level of overall cost of capital. Then I taught you regarding the point of indifference, that is the point in which the EBIT generates the same level of earning per shares to you, irrespective of your debenture and equity mixture. Then we learned about capital gearing. So now we have to start with that. There are four famous theories regarding capital structure. So first of all, you must know the answer of a specific question: why I have to study capital structure? If you know the answer of that, believe me, half of work is already done. Okay, so why you have to study that? You have to study that in order to get the idea of how much debt you should use along with the equity. Okay, how much debenture you should use along with the equity. So this should be your, how, what should be your strategy, and this question is answered by different capital structure theories. Okay, so if a company is using higher level of debentures, this company is known to have the high gear or levered form. Or if the company is using higher level of equities, this company is known as the company in a low gear uh, or unlevered form. Okay, so there are four theories which tells you the idea of what effect it has having the higher level of debts. Okay, so there are four theories, four famous theories, which tells you ultimately the effect of using more and more debt along with equity. So one by one we shall be covering all these theories. The first theory is very famous theory. This is net income theory or net income approach. So what does this theory says you? This theory says you that you have to use as maximum debt as possible, and if you use that, that ultimately shall leads to the two result. The first result shall be maximization of your maximization of value to your company and minimization of overall cost of capital. Okay, so this theory tells you you have to use as maximum debenture as possible. Okay, so net income approach uh, tells you that the firm may increase the total value of a firm by lowering its cost of capital. So they tell you if your overall cost of capital is reduced, ultimately the firm's value shall be increased. And how you can decrease or lower the cost of capital? The only way is to increase the proportion of a debenture in your total capital. And with the example I shall tell you how this can be done. Okay, so this income approach has some important features or characteristics which you have to understand. Okay, so it tells you that you have to increase the value of your firm. Okay, so it has some assumptions. The first assumption is cost of debt is less than cost of equity. So this is that cost of debt is lesser than cost of equity. The second is there are no taxes. And the third one is the use of debt does not change the risk perception of investor. All these three situations, or first situation can be number of times can be true, but the others are not true always. And nowadays if you are asking me the question what is the structure, that structure, what is the capital structure of a companies, although some of the company can be of a high leverage, but this is not the situation that they are using this specific approach, because this approach assumes that there are no taxes, and this is not the possibility ever. So now we have to understand this. Okay, so how we can understand? I have just placed one illustration in that. Okay, so by going through this illustration you can get to know that by using higher level of debenture along with the equity, the firm can attain the higher level of value of their company, and they can reduce the overall cost of capital. Suppose the EBIT or net operating income is 30,000. I told you EBIT is very important for you. So that's why you have to recall that table in your mind. Then equity capitalization rate or cost of equity capital is given 15%. The first is EBIT, second cost of equity, the third is cost of debt. This is 10%. Total capital is required 2 lakh, and there are 5 options available to you. This is leverage, level of leverage, okay, level of using debt. 0%, 20%, 50%, 70%, or 100%. You can use 0% debt, 20% debt, 50% debt, 70% debt, or 100% debt. So when we solve this question, you just see that, okay, so this is the degree of leverage. So here is equity. So the total amount has to be 2 lakh with all the alternatives. If we use 0% of a debenture, then the value of debt capital will be 0. If we use 20% of a debenture, then there shall be 40,000 worth of debenture capital. If we use 50% of debenture, then their value shall be 1 lakh. If we use 70% debenture, their value shall be 1,40,000. And if we use 100% of debenture, there shall be 2 lakh value of debenture, and the value of equity shall be 0. After that, just write the value of earning before interest and tax. This is 30,000 in all the cases. This is already given to us in the question. Then reduce the interest on debt. Okay, in case you have not used any kind of debt, you don't have to pay any kind of interest, and the rate of interest is given here. This is 10%. Okay, so just make 10% of all the debts in all the available options. In the first option, second option, this is 4,000. In next, this is 10,000, then 14, and then 20,000. And when you reduce that this will be the value of value available to equity shareholders. And remember that there are no taxes. Okay, so this is why we have not reduced that. Whatever the value is left now, this all is available to equity shareholders. Now, just to find the true value of equity shareholders, what you have to do, you have to divide earnings with the cost of equity capital. Okay, so what shall be the value of a firm? Value of the firm should be equal to value of equity capital and value of debentures. So debentures, this is 40,000, 1 lakh, 1,40,000, and 2 lakhs. But the value of equity can be found out with the specific formula. This is earnings divided by cost of capital. And when you solve this situation, individual level of the equity capital can be known. Okay, and when you just add these two, equity and debenture, you shall be left with the total value of the firm. And you can simply see that if, while just making a simple comparison, you can get to know that the value of a firm is higher when the firm is using 100% of a debenture. So this proves that if you use higher level of a debenture, then you can increase the value of a firm to the maximum extent, and ultimately it reduce the overall cost of capital. You can see the average cost of capital in all the cases: 30,000, 28, 25, 23, and 20%. So 20% is the lowest, that is in the last option. So this is how you can make the comparison. Using higher level of a debenture ultimately leads to the more value of the firm and a minimization of a cost of a capital. So you should not be concerned about this formula that shall be talked about while we study regarding cost of capital. I just made this illustration just to clear your concept regarding how firm can increase their value by using net income approach. Otherwise, you just have to be sure that the question is not going to ask you the exam is not going to ask you any kind of a practical. That was just for clearing your concept. And after that, you can this is just a simple explanation. Everything is already written in notes as well. This is quite clear that the value of a firm will be increased if the proportion is increased in debt capital, and there shall be reduction in overall cost of capital. And when we plot this in graph, we get this kind of picture. Okay, so this is a degree of leverage firm: 0%, 20%, 50%, 70%, and 100%. And this is the cost of equity, cost of debt, and overall cost of capital. This is weighted cost of capital. So this is 15%. 15% is the level of a cost of equity, and this is the 10%. 10% is level of a cost of debt. So this is just showing that as long as you are increasing the level of debenture in your capital, as long as you are increasing that, your overall cost of capital or KW comes down. And when this is at the maximum extent, or this is at the extent of 1, then your cost of capital is minimized or to the lowest point. So in this way, in the graphical format also, you can easily get to know the idea uh, regarding the net income approach. So this is all about that. Okay, so degree of leverage is plotted on x-axis, and the different cost of capital are plotted on y-axis. And in this way, you can make the relationship between these two. So I hope you have got the complete idea regarding what net income approach teaches you. It just teaches you that as long as you are using debenture in your capital structure, you can increase the value of your firm and you can decrease the overall cost of capital. So this was the very first approach. And remember one thing, if any company is highly leveraged, that doesn't mean that they are using this approach. This is a very outdated approach because it assumes that there are no taxes, and this is never the possibility. The next theory is going to be relating to net operating income. Okay, if you have understood the example of the first approach, then understanding regarding the second approach shall become very easy for you. Okay, in that, what you have learned, that there is the fixed cost of a capital for debt. Okay, this is cost of a capital, and this is cost of equity. And as you are using more and more of debenture, then your overall cost of a capital shall be reduced. Okay, so that line stood for overall cost of a capital or weighted cost of a capital. This was that theory. And net income approach was suggesting you that you have to use more and more debt in order to reduce the overall cost of your capital. But the net operating income approach is completely different from that. It's indifferent. Okay, so it is just telling you that using more and more of debt is not going to produce you any kind of a benefit. Okay, so the reason being, whatever the basic argument what have been cited in the net operating income approach is that whatever the benefit you are going to get with the lowered cost of with the lower or cheaper cost of debt, that shall completely be offset with the rising cost of equity capital. So so they just tell you that if you use more and more of the debt, ultimately the cost of equity shall be increased. Okay, so whatever the benefit you shall be getting, that shall completely becomes offset. So this is all that. Okay, so you shall be understanding with the help of example. Everything is already there, so we have placed it. So now we want to highlight the net operating income approach, which was advocated by David Durand, that is based on some assumptions. So these assumptions are the overall capitalization rate of the firm, KW. This is cost of overall cost of capital of firm is always constant and it do not change. Okay, it don't change. So this is the first assumption. It don't change irrespective of any degree of leverages. So this tells you that whatever the mixture of debt and equity can be, okay, so your weighted cost of capital is always going to be constant. The second is net operating income is capitalized at an overall capitalization rate in order to have the total market value of a firm. So they just tell you that to get the value of a firm, what you have to do, you have to capitalized okay, you have to capitalize overall capitalization. I'll tell you the formula of that, then you will get to know then how you can calculate the value of the firm. Okay, so V is equal to earning before interest and tax, and that should be divided by overall cost of capital. And when you calculate this, that shall produce you the value of the firm. and this value is obviously the sum of equity and debenture. And when you know the value of the debenture, after reducing value of a debenture from value of the firm, uh, you can easily get the value of the equity shares. Okay, so this is the formula for finding the value of the firm. Okay, because both are constant, okay, and independent of leverage. Then the next is, this is market value of debt is then subtracted from total value, market value of a firm, so that the value of equity can be obtained. Now you have got the value of a firm. Okay, how did you get it? Value of firm is equal to interest before earning before interest and tax, that is divided by weighted average cost of capital. Now you have got the value of the firm, and you know value of firm is equity plus debenture. If you reduce value of a debenture from the total value of a firm, you can easily get the value of equity shares. And after that, as the cost of debt is constant, the cost of equity will be calculated with this formula. Okay, so what is this? So cost of equity shall be calculated like earning before interest and tax minus uh, interest, and that shall be divided by the value of a firm, and that shall produce you the value of equity. And this varies. Okay, and this varies. So these are, I think these are the assumption. Now with the help of this specific diagram, you can easily get to know the idea behind the net uh, operating income approach. So what does it tell you? First of all, it tells you that the cost of debt is always constant. This is obviously the case. So this line refers to the cost of debt, and I hope that I do not have to explain you why. What does this OX axis stands for? This is just the degree of leverage. You can get any position like 0%, 20%, 30%, 40, 50, or any level of debt. Okay, and OY axis stands for the different costs like cost of equity, weighted cost, and the cost of debenture. So the cost of debenture, we are supposing that is 5, and we assumed under net operating income approach that overall cost of capital is also constant, and we are assuming it to be 10. So this approach tells you that whatever so if you are using more and more of the debenture, then ultimately the cost of your equity capital shall be rising. So whatever the benefit you shall get with the cheaper cost use of a debenture, that benefit shall completely be eradicated, or that shall completely be offset with the loss you shall bear with the increased cost of equity capital. So you are not in the position of gaining if you are using more and more degree of leverage. So under this approach, the most significant assumption is that the overall cost of capital is also always constant irrespective of degree of leverage. So the segregation of debt and equity is not important here, but the market capital, because the market capitalizes the value of firm as whole. So we have to take one example, and after that you can get to know more idea of that. So one practical was solved by us for a net income approach. Okay, and this is going to be the second practical, and on the basis of these two practicals you can understand all the 4 theories. Okay, so EBIT is 30,000, total value of capital structure is 2 lakh. This is already given to us. Cost of debt is given to us, and overall cost of capital, that is KW, that is 12% already given to us, and the leverage level is 0%, 20, 50, 70, or 100. So this is all the situation. Okay, so that is what all we have got. So if we solve that, we know at 0% level equity is 2 lakh, at 20% equity is 160, at 50% level equity is 1 lakh, at 70% level equity is 60, and at 100% level of leverage equity is 0. So by reducing this value from the total value of the firm that is given in the question, that is 2 lakh, you can easily get the value of a debenture as well. So you have got the total value, you have got the equity, you have got the debt value, and this is EBIT. EBIT is constant in all the situation. This is 30,000, and you have been given the interest rate 10%. So whatever the value of a debenture is, you can easily calculate the value of interest. So the first, in the first case, the value of interest is 0, and the second case, this is 4,000, then 10,000, then 14, and then 20,000. And when you reduce interest from the earning before interest and tax, you get the value available for the equity shareholders. So this is 30,000, 26,000, 20,000, 16,000, and 10,000. So now you can revise the value of the firm. We have already given you the formula. The formula was earning before interest and tax, and that should be divided with the weighted average cost of capital. Weighted average cost of capital is already given to us in the question, and that is 12%. So now what we have to do, we already know that the earning before interest and tax is 30. And when we divide this by 12%, we get the value of 2.50, 2 lakh and 50,000. In the same way, 26 divided by 12%, you get this value. Okay, so in the same way, so that is the total value. Okay, so this is going to be total value. So when 20,000 is divided by 12%, so the value of firm shall be 2 lakh 50,000, 2 lakh 50,000, 2 lakh 50,000. So you can get to know that the value of a firm is constant in all the situations. Okay, then but what we have got here. Okay, so we know the value of a debenture. I have already given you the formula that when you have the value of the firm, and if we reduce from the value of a firm, the value of a debenture, we can easily get the value of equity shares. Okay, so value of a firm we know. So if we reduce from this value, the value of a debenture, we can easily get to know the value of equity, and this is all there. Okay, so this is all there. So we are already given with the value of the debt. This is constant in all the situation, that is 10%, and the complete weighted average cost of capital, that is 12%, that is constant in all the situation. And finally, the cost of equity, we have already given you the formula for that. This is earning before interest and tax and divided by the value of a firm. And if you do that, then you get the cost of equity capital. In first case, this is 12%. In second, this is 12.4, then 13.3, then 14.5, and then 20. You can get to know that the value of equity is rising as there is more and more use of debt in the capital structure. So this ultimately proves that if you are using more and more debt in your capital structure, as the cost the overall cost of capital remains the same, ultimately the cost of equity capital shall be rising. So net operating income approach tells you that with the use of more and more debenture in your capital structure, you are not gaining anything, because whatever the gain you can achieve on the basis of use of debenture or leverage, that is completely going to be offset with the increased cost of equity capital. So this is all about that approach. Okay, so these two approaches are very contradictory. First, we have taught you regarding the net income approach, and secondly, we have taught you regarding net operating income approach. Net income approach taught you that if you use more and more of the debt in your capital structure, overall cost of a capital can come down. Okay, can come down, and you shall get the benefit. So that was the net income approach. But net operating income approach tells you that because the overall cost of capital is always constant, so you are not going to get any kind of benefit with the use of leverage. If you use the debenture, that benefit shall completely be offset with the increased cost of equity capital. So I hope you would have got the complete idea of two examples, and on the basis of these examples, the rest of the theories can easily be explained, and we are not going to include now any kind of practical example, because this is not viable for us from the point of view of our examination. That is not going to ask any kind of practical to you. So this is the third theory or the third approach, and this is the traditional approach. Okay, so this is the traditional approach. We can simply say that this is the hybrid system of both the previously learned approaches. So this is net income approach and net operating income approach. So this is some of these two. So what we have to do, so this theory tells you that up to a certain level, use of debenture gives you benefit, but after that level there are increased cost and you don't get any kind of benefit. So this is telling you that up to a certain level only you can get the benefit. So it is accepted by all that the judicious use of debt will increase the value of a firm and reduce the cost of capital. So the optimum capital structure is the point where the value of a firm is highest and cost of capital is lowest. This is obviously the case. But practically this approach encompasses all ground between net income approach and net operating income approach. That is called intermediate approach. So this explains that up to a certain point only, debt equity mix will cause market value of a firm to rise and cost of capital to decline. But after attaining the optimal level, what shall happen? The use of additional debt will cause to decrease the market value and increase the cost of capital. So this tells you that only up to a certain level you shall be benefiting, after that you shall be losing. So the basic proposition of this specific approach are as below. So this tells you that the cost of debt capital, this is KD, that remains constant. This is very obvious, okay, but that is up to a certain level and thereafter increases. So what does this assumptions tell you? Suppose you are going to raise the loan from debenture for the value from any value within 0 to 1 lakh, you can get at the rate of 8%. But when your requirements gets increased, like you need the funds from 1 lakh to 5 lakh, so you can get these funds at the rate of 10%, and cost of raising the funds through debenture increases if the value also increases. So for just getting the finances or funds from the level of 5 lakh to 10 lakh, you have to bear the cost of 12%. So in this way, you can get to know that more and more the debentures are employed, more shall be the cost of a debenture. So this is the reason, basic reason why this theory is an intermediate theory, because it tells you that the cost of capital remains constant more or less up to a certain level and thereafter it increases, like I have already given you example. So the cost of equity capital, that remains always constant for more or less point, okay, and ultimately it also start increasing gradually after a certain level, okay. So the average cost of capital or KW, that decreases up to a certain level and then remains unchanged, and thereafter it also starts rising. So you shall get to know with the idea of this, okay. So you can see that the cost of a debenture is more or less constant at 10%, but when you are increasing more and more debenture, what happens? The cost of debenture also becomes higher and higher, because if you need more and more funds, obviously the investors shall be charging more and more. In the same way, in the case of a cost of equity, when you are employing more and more of the debenture, the cost of equity remains constant up to a certain level or certain time period, and thereafter it starts increasing. So what shall happen with the overall cost of capital? It shall decline up to a certain point for the employment of the debenture, and after that level it shall start rising, okay. So this completely tells you, this is the summation of net income approach and net operating income approach. You can easily get to know that when we talk about net income approach, the first part of this graph deals with the net income approach, and the second part deals with the net operating income approach, that tells you more and more use of debenture shall ultimately lead the more and more cost of equity capital, and that shall not produce you any kind of benefit. So I hope you have got the idea. Okay, so this is all about that. So that was the intermediate approach. So we have studied three approaches right now. First, we have studied the net income approach, which tells you that employment of more and more debenture funds can generate you more and more revenue, and it can increase the value of a firm. But the net operating income approach tells you that employment of more and more debenture shall not produce any kind of benefit. And the traditional approach is an intermediate approach that tells you the employment of debenture shall produce the cumulative effect or the cumulative impact of net income approach and net operating income approach as well. So I hope you have got the complete idea. Now I'm just going to move further with the most important and the last approach for deciding the optimal capital structure, and that is going to be relating to Modigliani and Miller approach. So what's this approach? This is very important, very beautiful concept to learn. Okay, so what's that? So Modigliani and Miller have given so many approaches as far as financial management is concerned. We have to study them while studying regarding dividend decision and some other concepts as well. So they have given their hypothesis, which is based on two different conditions. The first condition is where there are no taxes. In the first condition, they are assuming that there are no taxes, and in the second condition, they are assuming that there is existence of a tax. And now, if we are making the conclusion of the theories given by M and M, so this is all that. Modigliani and Miller approach basically can be bifurcated into two parts. So basically they have given two theories for capital structure. The first is assuming no taxes, and the second is assuming existence of taxes. Okay, so where there are no taxes, where there are no taxes, then this theory resembles exactly with the net operating income approach. So that tells you that value of the firm is not going to rise in any way. Okay, it's not going to rise. Okay, so it's completely benefit of employment of debenture completely offset with the increased cost of equity capital. And when there are existence of taxes, the theory of Modigliani and Miller resembles with the net income approach. They tells you, yes, you can increase the value of the firm if you are employing a debenture in your capital structure. So we can see that Modigliani and Miller approach is just the confirmation of both of the theories, that is net operating income approach and net income approach. But the confirmation has been given on the basis of two conditions. If there are no taxes, then the operation of net operating income approach shall be held, and if there is existence of taxes, then the operations of net income approach shall be held. So one by one we shall be studying all those. Okay, so Modigliani and Miller advocated the relationship between cost of capital, capital structure, and valuation of firm, and that should be explained on the basis of net income approach if there are no taxes. Okay, so they are assuming some of the things. Okay, so the or Modigliani and Miller, they support the net operating income approach on the principle that the cost of capital is dependent upon the degree of is not dependent upon the degree of leverage, irrespective of debt and equity mix. In other words, according to their thesis, total market value of the firm and cost of capital are independent of capital structure. So whatever the capital structure you use, like leverage is 0%, 20%, 40%, 80%, or 100%. So it is not going to make any kind of impact on the weighted average cost of a capital and the valuation of the firm. So it's not going to make any kind of any kind of effect in those things. Okay, so they advocated that the weighted average cost of a capital does not make any change with the proportionate change in debt and equity mix. So you can see that whatever the degree of leverage is there, so overall cost of capital shall always remain same. Okay, so if we just make the plot of net operating income approach, that tells you that employment of more and more debenture in your capital structure shall ultimately lead to rising cost of equity capital. So whatever the benefit you are getting from employment of cheaper cost funds, these are debenture, that these benefits shall completely be offset by the increased cost of equity capital. So this is all about that theory. Okay, so why does it happen? This happen on the basis of some assumptions which we have to study. So their proposition is based on following assumption. The first is existence of a perfect capital market. Okay, so they just assume that there is existence of a perfect capital market. That means there is no transaction cost, there is no flotation cost, no investor can affect the market, all the information is available, and investors are free to purchase and sell securities. And that assumption was highly criticized in the forthcoming researches. So that hypothesis is based on all these things. Okay, so the second assumption is a homogeneous risk class or equivalent risk class. Everybody is taking the equal kind of risk, which is never the case. So it means that expected yield return have identical risk factor. That is, business risk is equal among all firms having equivalent operational conditions. They all are having the equal risk level. Okay. The third is homogeneous expectation. All the investors all have identical estimates about the future rate of return. The next is the dividend payout ratio is 100. The assumption of this theory is that whatever the company is earning, all these earnings are going to be distributed to its shareholders in the coming days. Most important assumption, there are no taxes do not exist. There will be no corporate tax effect, although this was removed at the subsequent date. So if we make interpretation of the hypothesis, so hypothesis reveal that if more debt is included in the capital structure of firm, the same will not increase its value, as the benefit of a cheaper debt capital are exactly set off by corresponding increase in the cost of equity. And this is the crux, and this is the conclusion of this theory, which I have already told you, under net operating income approach, and this do not have any kind of difference with that. So according to the total value of a firm is absolutely unaffected by the capital structure, that is debt and equity mix, when corporate taxes are ignored. So this is all about the first part, or the first theory given by Modigliani and Miller. And now we have to study this hypothesis with the existence of a corporate taxes. So Modigliani and Miller suggested that if there is the existence of a corporate taxes, what happens? Then you are at the position of a similar position with net income approach. That means use of a debenture can produce you benefit with the decreased cost of a capital. Okay, so they have given a very we can say the very best proof or evidence of their theory. That is very easy to understand. Okay, so I have already given you the formula, I have already given you the complete structure. You know, this is EBIT. When you reduce the interest from EBIT, then you get the value of EBT, that is earning before tax, and when you reduce taxes from EBT, then you get the earning available for equity shareholder. So tax is the deductible item. So this is the deductible item. So now you can get to know that. I'm just going to give you a very simple example. Suppose if there are no taxes, so if you are earning 15,000 EBT, if you are earning 15,000 EBT, then uh, what happens? You have to distribute all that income. Okay, you have to distribute all that income. So when you have issued the debenture, obviously you have to pay them the interest. Okay, so suppose there are 15,000 of total EBIT. Okay, so if you have not uh, suppose if you have not issued any kind of debenture, so this is 0% levered firm, then you don't have to pay any kind of interest. In that case, you have to pay the taxes on the total amount of 15,000. That means you have to pay, if the tax rate is 50%, suppose I'm taking a hypothetical figure, then from 50,000 you have to pay 7,500 rupees as a tax. But in case, suppose you have employed the debt, uh, the debenture to which you have to pay the interest of 5,000, then a tax is a deductible expenditure. So after deduction of the interest from the EBIT, you are left with the value of 10,000 only. Now you have to pay the tax on this 10,000 only. So when we calculate the tax on this 10,000, that comes to be 5,000. So you earn or you save 2,500 rupees tax. The taxability of a 2,500 rupee is saved by employment of the debt in your capital structure. The only reason is the interest is an admissible expenditure. The interest is an approved expenditure that can be deducted from whatever the income you are earning from your business. So this is all the hypothesis of Modigliani and Miller. If the corporate taxes are in existence, they have given two kinds of firms. The first is unlevered firm, and the second one is a levered firm. Okay, so unlevered firm is the firm which do not have any kind of debentures, but the levered firm is the firm which has debentures. Okay, so if there is unlevered firm, this is not going to get any kind of benefit. But if this is a levered firm, they are going to get the benefit of the deductibility of interest from EBIT. And if interest is deducted, obviously you have to pay lesser taxes, and then you are at the gaining position. So this is the hypothesis given by M&M. So we are now going to examine the effect of corporate taxes in the capital structure of a firm along with MM hypothesis. We also know that when taxes are levied on income, debt financing is more advantageous, as interest paid on debentures, debt is a tax deductible item, whereas a retained earning or a dividend so paid in equity shares are not tax deductible. So we know that if debt capital is used in a total capital structure, the total income available for equity shareholders will be more, because you have the deductibility of a tax. So in other words, the levered firm which has employed the debenture, so the levered firm will have a higher value than unlevered firm for this purpose. Or it can alternatively be stated that the value of levered firm will exceed the unlevered firm by an amount equal to the debt multiplied by the rate of tax. So whatever the tax you have saved, so the value of the levered firm shall be enhanced with that specific value. So you can easily get the formula. Okay, so this is value of a levered firm is always equal to value of unlevered firm plus tax rate multiplied by the value of the interest of the debenture. So this is all about that. Okay, so I hope you have got the idea. So value of unlevered firm is lesser than the value of the levered firm. So value of levered firm can be calculated with this specific formula. So now you can get to know that uh, where in case the value of unlevered firm is lesser than value of levered firm, that ultimately means that using debenture in your capital structure produces you more value. Okay, so this was the basic hypothesis um, on the ground of which Modigliani and Miller suggested their next theory regarding capital structure. So with the use of corporate taxes, the capital structure can be made fine in a way that you can the value of your firm can be increased. So a firm can lower its cost of capital continuously due to tax deductibility of interest charges. So a firm must use maximum amount of leverage in order to attain the optimum capital structure. Although the experience that we realize is contrary to the opinion. So this is not the case. What we have to study, this is all about the theory of on the basis of the existence of a corporate taxes. You are not supposed to go through from any practical, that is not going to be asked to you, but I think you are cleared with the concept right now. So in the real world situation, however, firm do not take a larger amount of debt and creditors are also not interested to supply high levered loans. So this is all the case. I hope you have got the complete idea. So if we are just making the conclusion of all the theories, what you have learned, that is very important for you. Okay. So why this is important for you? First of all, you have to understand regarding the net income approach, which tells you that you have to use debt more and more so that the value of the firm can be increased and cost of overall cost of capital or cost of or KW could be decreased. And net operating income approach tells you that whatever the mixture of debt and equity is, value of the firm is not going to be increased in any way, and the cost of overall cost of working capital is always remaining constant. So this is that. Then there is traditional approach, which is also known as intermediary approach. So that tells you that employment of debt capital benefits you up to a certain level, and after that level the cost of equity starts rising. So traditional approach or intermediary approach is the sum of net income approach and net operating income approach. And the last case, it is Modigliani and Miller's hypothesis that can further be bifurcated into two parts. The first, where there are no taxes, and second, if there are taxes. If there are no taxes, then the hypothesis of Modigliani and Miller is exactly similar to net operating income approach that tells you that value of a firm is not going to be increased if there are no taxes. But if there are taxes, then their hypothesis is equal to the net income approach, and that tells you that the value of a firm is going to be increased if you use more and more debt in your capital structure. So these are all about that. I hope you would have enjoyed and you would have got the complete idea of what is there for us to study in this specific lecture. So regarding the next lecture, I'm going to tell you what's that going to be. That shall be regarding the cost of a capital. Okay, so capital structure in complete detail we have already understood. So regarding the next lecture, this is cost of a capital. Whenever the lecture is taken, right, and we shall be informing you as soon as possible. Thank you so much for joining me. This is Gurpal Singh from Dusra Education.